blog, December 18th, 2011. So it's been a while since I've done a blog, but I think it's time again to do one. I've been off for a while. Starting out as usual with the New York composite, and the first thing I'm looking here is once again the 1030, the 10-day exponential moving average over the 30-day exponential moving average. The 10-day is the red line, the 30-day is the green line. If you only restrict your trading down to always going long a stock that has the red line on the top, like here, and the green line on the bottom, and you short stocks that have the red line on the bottom and the green line on the top, then this is basically an easy way to see whether you're actually in a bear market or in a bull market. And the crossover points are quite important here. So we currently have a bearish crossover of the New York composite, and that's on declining tops. So we get declining top here, there, here, there. It's not very clean, but bear markets like this are never very clean. They're always panic, especially with the US investing public, which seems to be a bipolar slash a manic depressant type of personality of everything being either all great or all terrible. There's nothing in between. There is no so-so. It's either all in, all out. That's why you see these drops, these huge drops, and it seems to be getting worse as time goes along. And when you combine that with a weekly 1030 crossover, then you see you've got very, very long periods where stocks really, where these two lines really don't cross over. And it helps you keep in a winning trade, and it helps you stay out of losing trades. So when we look at the same market on a weekly basis, we're definitely still in the bear market here. Just like we were in a bull market starting, when was this? About June of 2009. And there was a tiny crossover here, and then there was another year basically of bull market, and then this last year it hasn't been looking so good. So this is no particular time to take any great risks. Bear markets are very hard to trade. The returns are very good, but as the market turns on a dime, it's very, very difficult to actually make money. If you haven't made any money over the last 2 years, don't feel bad. Lots of people with 20 and 30 years of experience have not made money in this market. A lot of people have lost money. So it's very, very hard. The smartest thing really would have been to just stay out and be in bonds for the last year, even if they pay very little. So going back to the stock market, again, we have a bearish crossover, and who knows where that is going to go. So being defensive and keeping your powder dry until the point when there will actually be growth might not be a bad idea. Or day trading. Day trading does work because it's not so much dependent on big events, and then it's small stories. Looking at the core sectors, so we've got the S&P 500 overview, again crossing into potential bearish territory here. Looking at the materials, materials again are definitely in a bear market. Energies, again, relatively weak, not as weak as the materials, but potentially turning down here again on declining tops, always a bad sign. And we're below the 200-day moving average in the energies. Financials, obviously a mess. The unfortunate part is that when the Fed and Washington bailed out the banks, they didn't fix anything. In fact, they rewarded bad behavior, and as a result, none of the problems really got fixed. Banks are in as bad a state as they were back in 2007, and the egos had just gotten bigger. Industrials, again, declining tops here. another drop. Then we've got technology. This is the bullish part of year. Just before Christmas is really when these stocks, technology stocks, should be taking off. Now technology is pretty strong, but we have a 1, 2, 3, 4 times this top has gotten tested and it hasn't managed to break through, and now we have a lower top right here, and we're going even lower here. So in this being the strong part of the year, that's definitely not a very strong sign for technology. Then we've got consumer staples. Of course, defensive stocks are doing relatively well. If you can find a good dividend paying stock in this consumer staples world, that might just be a reasonably good place to park some money until things get better. But even there, the OBV seems to be rolling over. Um, and all I can say to that is the name of the game is deleveraging. For the last 60 years, leverage has been built up, and it is slowly draining out of the system. And when the tide goes out, all ships go down equally. That's just when money leaves the market, then we return back to a lower base. Even good stocks will do that. Utilities, again, defensive stocks, dividend paying stocks do reasonably well, and it's kind of an environment simply because they pay better interest in forms of dividends than if you put your money into bonds or into other interest bearing um, investments that return basically nothing at this point. So utilities is one of the few sectors that has actually stayed above the 200-day moving average. Healthcare, again, just flirting with the 200-day moving average. Nobody knows exactly what's going to happen with healthcare next. But so the market can't really decide whether it should be going up or down. I'm not sure if I would go into healthcare at this point, considering the political background of it. And then there's consumer discretionaries, stronger than I expected it to be, to tell you the truth, under the circumstances, but still not particularly strong. And again, it has fallen below the 200-day moving average. So, and we once again have declining tops here. So this is no real place to put money at this point either. That doesn't necessarily mean you can make money on the short side either, just because the short side shorting stocks always seems to be whatever you think should go down might just get bailed out, and that too is a dangerous place to be. A few things that I'm playing with. Going back to bonds, of course, there has been a huge move into bonds, specifically U.S. bonds. Actually, let's look at the U.S. dollar, which has been very strong as of late. It reached a low of 72.70 down here, and currently it's trading as 80 as money is escaping out of Europe, looking for a safe haven. The US dollar might be flawed, but it's less flawed than most other currencies out there, and it's the only one that can actually absorb that much money. So that's where Europeans and Asians are fleeing to when there's a time of crisis. You always go into the major currency, and that still happens to be the US dollar, warts and all. Um, and that is then the reason why gold, for example, has actually dropped below the 200-day moving average, because money is even draining out of gold and back into US dollar, which is also what happened back in 2008, simply because when there is a liquidity crisis, when there are margin calls that need to be made, that need to be paid for, then you sell the asset that is most liquid. Of course, gold is very liquid, so people will be selling their gold. But this move down is in very large part a rise of the US dollar rather than a drop in gold. I am still a gold investor. I continue being a gold investor because it's the only investment I can think of that has actually held its value for the last 8,000 years. That's not a bad track record. Silver, same thing. I do continue to like silver. I think if we start to drop a little bit further, even here, I'm starting to scale into a few silver positions. I started selling out of silver when it got crazy up here, and some more here, and now it's starting to get cheap again. There is still a shortage of silver. There continues to be a shortage of silver, and eventually this price will go up. Um, so now is not a bad time to buy. I mean, I'd be a buyer myself. Oil keeps flirting with $100, has dropped a little bit again, mostly on the US dollar going up, more so than oil going down. It does have a potential crossover here, and it's slightly below the 60-day moving average. But again, oil, I like resources simply because you can't print resources. You can print money. Um, one of the things I am considering right now is eventually we're going to see higher interest rates. There's no way that people will continue to lend governments, any governments, money at 0% interest. It's a temporary panic into treasuries, into bonds, and eventually that will end and interest rates will go up. I can see here is the 20-year long-term bond, and there's an inverse of this one. It's the TBT. It's been dropping substantially, and I can see this in the next year going higher again. So this is one of my speculations, that interest rates will go higher, bonds will drop, and this inverse will go up. So that's as I said, that's one of the things I'm playing with right now. Apple, interesting chart here. Again, a very strong stock, good income, and yet the market is not really rewarding it because, again, it has declining tops, and this should really be the strongest part of the year for Apple. iPhone and iPad sales are strong, and yet the stock is dropping, and stocks frequently precede the economy by 6 to 9 months, which might just mean that the consumer's tapped out, there's less credit, and therefore there's less willingness to buy things that one really does not need at prices one really cannot afford with money one really doesn't have. That's all I have for today. So right now I'm pretty well sitting on a fence waiting for the next thing to happen, but the market's certainly not looking as strong as it should this time of year. Um, we'll see what happens next week. All the best, and make lots of money next week. Bye.